Have you ever wondered why some people manage to build wealth without showing off, without chasing risky investments, and without working themselves to the bone? While the majority continue to struggle with debt and daily expenses, there's a small group of individuals quietly accumulating wealth steadily and sustainably. They didn't get rich by luck. They got rich because they followed principles. In this video, you'll discover 5 money rules that Warren Buffett, the legendary investor, has followed throughout his life. These are the same principles that millionaires use to quietly build lasting wealth, without noise, without chaos, and without compromise.
Principle 1. Buy income-generating assets. Don't spend it all on liabilities. In today's world where advertising, social media, and social trends constantly push us to spend in order to show status, maintaining healthy personal finances is becoming increasingly difficult. This is especially true for those in their middle age, where financial pressure comes from both ends, raising children while also preparing for retirement. At this stage, every financial decision must be made with even greater caution. Warren Buffett, one of the most successful investors in history, once shared a seemingly simple financial philosophy that has become the foundation of his enduring wealth. Only buy assets that generate income, and stay away from liabilities that offer no lasting value. So what exactly are income-generating assets? These are things that produce cash flow, appreciate over time, or allow you to build wealth steadily. Think of stocks in strong, established companies, government bonds that offer regular interest payments, rental properties that generate monthly income, or equity in a profitable business. In contrast, liabilities are items that usually depreciate immediately after purchase, generate no financial return, and may even cost you money to maintain. New cars, the latest tech gadgets, luxury furniture, or expensive vacations may offer short-term satisfaction, but they don't move you any closer to financial freedom. Warren Buffett never chases after flashy possessions to show off his wealth. He still lives in the house he bought in 1958, doesn't drive luxury cars, and rarely spends on things that don't add long-term value. Even as a billionaire, he remains grounded in one principle: let money work for you, not the other way around, and never spend just to please your ego or impress others. For middle-aged individuals, this principle becomes even more crucial. After decades of hard work, you may have built up a reasonable amount of savings, but how you use that money will ultimately define your financial future. Investing in income-generating assets means building passive income, a steady stream of earnings that doesn't rely on your daily labor. This is the bridge to financial freedom and a comfortable retirement. Let's take a relatable example. Instead of spending $40,000 on a brand new car that loses 15% of its value the moment it leaves the lot, you could invest that same amount in a well-performing ETF with an average return of 7% annually. Over the next 10 to 15 years, that investment could double or more, while the car will be worth just a fraction of what you paid. Or, if you have idle savings, instead of upgrading your kitchen to follow the latest interior trend, consider purchasing a small rental property. The rental income can help cover your living expenses, while the property itself grows in value over time. The long-term benefits of owning income-generating assets go far beyond just returns. It's the peace of mind, knowing that you can weather economic downturns, still have income when you're no longer working, and have the means to support your family when needed. With inflation on the rise and people living longer than ever before, preparing for retirement isn't optional anymore. It's essential. Income-generating assets not only preserve your wealth, but also help you grow it in a way that outpaces the erosion of time and cost of living. There's no quick and easy formula for getting rich, but understanding the difference between liabilities and assets and choosing to invest in things that truly build value is the first step toward gaining control of your financial future. Silent millionaires don't need to boast. They let their assets do the talking. And what they have isn't luck, it's discipline and long-term vision. If you're 40, 50, or even 60 years old, it's never too late to start. Take a hard look at how you're spending your money. Ask yourself, is what I'm about to buy an asset or a liability? Will it move me closer to my financial goals, or is it just temporary satisfaction? When you begin to prioritize income-generating assets, you're not just changing the numbers in your bank account, you're changing the way you think about wealth, and that, above all, is the foundation of a strong, free, and sustainable financial life.
Principle 2. Save before you spend. Don't let money control your emotions. In a consumer-driven society like the United States, where every advertisement is designed to make you feel like you need to buy this right now, learning to manage your emotions when spending money is a critical financial survival skill. This is especially true for those in middle age, when financial pressures are mounting, from everyday living costs and raising children to preparing for retirement. At this point in life, every spending decision demands clarity and self-control. Warren Buffett, famously known as the Oracle of Omaha, lives by a simple yet powerful rule. Save before you spend, not the other way around. He routinely sets aside 20 to 30% of his income the moment he receives it, either into investment accounts or savings, before touching the rest for any expenses. It may sound basic, but this habit has a profound impact on how one builds long-term financial stability. Prioritizing savings first puts you in control of your spending emotions, one of the biggest reasons people fall into debt. When you spend based on feelings like, "I'll buy this to feel better," or "I need it because everyone else has it," you're letting money control your behavior instead of taking charge of it yourself. On the other hand, saving first draws a clear line around your spending. Even as your income grows, this discipline keeps you living within your means. You no longer feel the pressure to chase trends, buy the newest car, or own the latest tech, because you know what truly matters: long-term financial security. Saving before spending doesn't just help you budget better. It creates a financial safety net that most people forget about until a crisis hits. Job loss, accidents, surprise medical bills, or a sudden recession. These things can strike at any time. And when they do, those with strong savings don't panic or spiral into debt. They face the storm with confidence. A recent survey showed that nearly 60% of Americans can't cover a $1,000 emergency expense. That's an alarming figure, especially for people at an age where financial stability should be a top priority. If you're in your 40s, 50s, or beyond, building and maintaining an emergency fund is not optional. It's essential. This fund doesn't have to be massive from the start, but it must be consistent, grown steadily from the habit of saving before you spend. You can begin by putting aside just 10%, then gradually increase it to 20 or even 30% of your monthly income. Automate the transfer to your savings account the moment you get paid. Treat it like a non-negotiable bill you owe to your future self. The benefits aren't just about the dollar amount. They lie in the sense of control you gain over your financial life. Instead of feeling overwhelmed every time your car breaks down, your child gets sick, or an unexpected expense pops up, you'll have the peace of knowing you're prepared. And that mental freedom is priceless, an invisible asset with tremendous power. Don't wait until your finances are in trouble to start thinking about saving. When you let emotions dictate your spending, you put yourself in a reactive position. But when you save first, you're in charge. Just like Warren Buffett, you don't need to be a financial genius to follow this principle. You simply need to make one clear decision: prioritize your future over short-term gratification. Starting today, by saving before you spend, is the most practical and powerful step you can take toward building a stable and secure financial foundation for the years ahead.
Principle 3. Long-term investing. Stop chasing the market. In an era where financial news floods every platform, from television and social media to investment apps on your phone, it's easy to get caught up in the minute-by-minute swings of the stock market. Every dip in the Dow, every sensational headline can trigger panic or overexcitement. But for truly successful investors like Warren Buffett, the strategy is the exact opposite. Think long-term and stay far away from herd mentality. Buffett doesn't waste time guessing whether the market will go up or down next week. He invests in businesses he understands, believes in, and, most importantly, knows have real enduring value. Once he buys, he holds for years, often decades. As he once said, "Our favorite holding period is forever." Buffett's long-term approach offers a powerful emotional advantage. You don't have to stay up late reading economic news, you're not anxious over every market correction, and most importantly, you're not trapped in the risky game of short-term speculation. For those in middle age, this principle is especially relevant. At this stage, your time, energy, and focus should be on your career, your family, and your health, not on tracking every tick of the stock market. A steady, disciplined, long-term investing strategy allows you to build wealth with peace of mind. Imagine investing in an S&P 500 index fund, a broad representation of the 500 leading companies in America, and holding it for 10, 20, or even 30 years. In the short term, the market will swing unpredictably, but over the long haul, the trend has always been upward. History shows that despite crises, recessions, or wars, the U.S. economy recovers and continues to grow. Buffett isn't swayed by daily bad news because he knows the value of what he owns. When you invest in a strong business that consistently generates profits, you don't panic when the stock price drops in the short term. As long as the business fundamentals remain solid, your investment will appreciate over time. Another major benefit of long-term investing is low cost. Constant trading doesn't just cloud your judgment, it racks up transaction fees, taxes, and the risk of mistiming the market. In contrast, a buy-and-hold strategy minimizes costs, boosts performance, and maximizes the magic of compound interest, what Buffett calls the eighth wonder of the world. In reality, most self-made millionaires in America didn't get rich from winning the lottery or risky bets. They built their wealth through disciplined, long-term, consistent investing. They bought assets, didn't sell when the market dipped, and kept investing, regardless of short-term economic noise. If you're in your 40s, 50s, or beyond, you don't need to try to beat the market every day. What you need is a clear strategy focused on real value and the discipline to stick with it. Choose stable funds, strong businesses, and let time do the heavy lifting. You don't have to be a financial expert to invest well. What you need is patience, discipline, and faith in long-term value. Investing isn't a game of speed, it's a test of endurance. And when you stop chasing the market, you start building wealth quietly, steadily, and intelligently. Just like the silent millionaires who've been doing it all along.
Principle 4. Always keep emergency cash. Never let yourself be forced to sell assets. One of the most common reasons people lose everything during a financial crisis isn't because they made bad investments. It's because they didn't have enough cash on hand to survive the storm. They're forced to liquidate assets at the worst possible moment when prices are low, market sentiment is panicked, and buyers are scarce. Warren Buffett, the legendary investor, understands this all too well. That's why he always keeps at least 10% of his portfolio in cash or highly liquid assets. The real reason behind this isn't about being overly conservative or not knowing how to invest better. It's about maintaining control. When a crisis hits, like in 2008 or more recently in 2020, many people are forced to sell stocks, real estate, or even valuable assets at rock-bottom prices just to get cash. But Buffett does the opposite. He uses his emergency cash reserves to buy valuable assets that the market is unfairly discounting. Keeping a portion of your wealth in cash doesn't mean letting money sit idle. On the contrary, it's an incredibly smart defensive strategy that prevents you from being backed into a corner. With cash on hand, you're not only avoiding fire sales, you're positioning yourself to seize opportunities when others are panicking. Imagine you're in your 50s and you've just made a major investment in the stock market. Suddenly, a recession hits. If you don't have a cash reserve, you might be forced to sell at a loss to cover medical bills, living expenses, or urgent needs. But if you have a strong cash cushion, not only can you hold your investments through the downturn, you can also buy more quality stocks at bargain prices, like shopping a clearance sale in a supermarket. That's the power of liquidity. You're not trapped. You're not pressured to make desperate decisions under stress. You can wait for the right moment, or take advantage of rare opportunities that only come during turbulent times when valuable assets are dumped due to herd panic. Beyond opportunity, emergency cash gives you peace of mind. You don't panic when the market dips. You don't lose sleep over bad headlines. Most importantly, you make decisions with clarity and logic, not fear. At middle age, stability and risk control matter more than chasing quick profits, and cash is a key pillar of that stability. A smart emergency fund should cover 6 to 12 months of essential expenses without requiring you to sell any investments. You can park this money in high-yield savings accounts, certificates of deposit, or CDs, options that preserve liquidity while earning modest returns. By following this principle, you're not just protecting your assets, you're giving yourself a powerful edge over most investors who only react when they're forced to. In the world of finance, the winners aren't always the fastest. They're the most prepared, the most patient, and the most ready when opportunity knocks. Keeping cash is not a waste. It's a strategic decision made by wise investors, those who understand that risk management is the true foundation of lasting wealth. Take a page from Buffett's playbook. Never let yourself be forced to sell, and always hold some cash as your silent power on the journey to financial freedom.
Principle 5. Invest in yourself. Your greatest asset is your mind and skills. Among Warren Buffett's many financial principles, the one that surprises people the most has nothing to do with stocks or real estate. It's his firm belief in this simple idea: the best investment you can make is in yourself. For Buffett, the highest return investment doesn't come from Wall Street. It comes from lifelong learning, sharpening your mind, and developing your personal skills. Every day, Buffett spends most of his time reading books, business reports, market research. He believes that sound thinking and deep understanding are the foundation for every wise decision, not just in investing, but in life. And the beauty of knowledge and skills is this: they never lose value, no matter what the market does, no matter how old you are. For those in their 40s or 50s, this principle is more important than ever. The job market is competitive. Technology changes rapidly. Skills that made you successful a decade ago may not hold the same value today. But this stage of life also gives you a powerful edge: experience. With the right updates, new skills, relevant knowledge, you can significantly increase your value in the marketplace and in your own financial journey. Investing in yourself can take many forms: reading books, taking online courses, learning digital skills, improving financial literacy, or simply strengthening communication, critical thinking, and creativity. Today, there are countless accessible platforms, Coursera, Udemy, YouTube, that let you learn anytime, anywhere, regardless of age or educational background. The benefits of continuous learning go beyond knowledge. They open new career opportunities, improve your performance at your current job, and most importantly, they give you the ability to adapt.
In times of economic uncertainty, the people who thrive aren't always the ones with the most money. They're the ones who think clearly, act quickly, and draw from a broad set of skills to pivot and grow. Learning also builds financial confidence. When you understand how money works, how to plan for retirement, assess risk, and allocate your investments, you're no longer driven by fear when crises hit. Instead, you become the one making calm, informed decisions. You're in control. And beyond finances, personal growth supports mental health and a renewed sense of purpose. Many people in midlife hit a period of confusion. Careers stall, kids grow up, and life can start to feel directionless. But when you keep investing in yourself, you keep evolving. You feel a sense of progress, and that progress brings energy, meaning, and motivation back into your daily life. Remember, no one can take away what you've learned. Stocks can drop, real estate markets can crash, but your knowledge and skills stay with you, and they are the assets that will pay you for life. Buffett once said, "The best investment you can make is in yourself." If you want lasting wealth, independence from the economy, and the resilience to face any challenge, start with this simple, powerful habit. Never stop learning. Whether you're 40, 50, or even 60, it's never too late to grow. And that growth could be the single biggest financial breakthrough of your life. Wealth isn't luck. It's built with disciplined action. You can start today, regardless of your age. A small mindset shift is all it takes to change your future. If you found this helpful, like, subscribe, and share this path to freedom with others. To take your first step, comment below. Which of the 5 principles will you commit to first? We'd love to hear your plan.